We're going to give folks just a moment to get in. We're going to give folks just a moment to get in. Duh, forgot to turn that off. If you can hear me, somebody type into the chat and let me know that you can hear me. Thank you, appreciate that. Let's see what my delay is tonight. For some strange reason I have a delay. Is the video coming through okay with you guys? I made some changes to try and tweak it. All right. We're going to cut that wonderful little song. And let's get into it. Let's see, let me get an idea on my delay here. And move my mouse. 1, 2, 3, 4. So about 3 seconds delay. All right, so bear in mind I do have a little bit of a delay. And so kind of keep that when I pause and ask for questions and things like that, kind of be a little dead silence, or I'll make a joke or something, who knows. Anyway, good evening, everybody. And for our posterity, it is March the 12th, 2024, 8 p.m. Eastern Standard Time. My name is Marziti, and this is Intro to Price Analysis and Strategies. And we're going to cover, this is part 3 of a 4-part series running on Tuesdays and Thursdays. And so this week we'll have part 3, part 4. And then depending on the feedback and stuff like that, we will talk about starting it back up with part 1 again next Tuesday. Or if the feedback, depending on the feedback, we can also look at doing a part 5, a 6, or 7 on different things like trading indicators and different things like that. I'm going to be looking for a lot of feedback from you folks on that. Okay, let's move on here. The standard disclaimer legal kind of stuff. This is a private presentation that I created. It is not created by the Bullish Bears. I am not a financial advisor. This video is for education purposes only. I am, like you guys, a member of the Bullish Bears community. I am not a moderator. I get no compensation in any way for doing this presentation here. The things that I present here are not necessarily the opinions of the Bullish Bears moderators, owners, or whatever. Ultimately, you're fully responsible for your own trades, and you're welcome to copy my video so long as credit is given. All right, let's get into it. This has been a question that keeps popping up, so I just threw a slide in here. These are my candle colors that you'll see on my charts. This is my red candle, a standard red and green candle. Red is a bearish candle where we opened up here, we closed down here. My bullish candle opened down here, closed up here. And one thing that you'll see on my chart is an inside candle. Excuse me. An inside candle is a candle, let's see, I've just picked up, Signet told me about this utility here called Ep3, and so I'm going to give this thing a try tonight. You'll notice in this case here that the high of the white candle was less than the high of this white candle, or a green candle, excuse me, and the low of this white candle is higher than the low of this green candle. So in other words, this white candle is inside the shadow of the green one. So we call it an inside candle. The opposite of that here is this blue candle, where we can see that the high of this one easily took out this area here, and the low of it easily overcomes. So we would call this an outside candle or an engulfing candle. So you'll see this white and blue on my charts. You will not have them necessarily on your charts. When we get over to Trade-Ovate, if someone's interested there, I'll be glad to show you how I turn these on. Okay. Any questions about that before I go on? All right, let's move on. And let's see. Come on. Advance the slide. Oh, maybe I got to get the pointer up. There we go. We're going to start off with moving averages. Now, this is an old school kind of technique, and it works. And I'm going to say this when we talk about all of our different kinds of we talk about all our different types of strategies. You know, we've talked about the box, we've talked about the Fibonacci's, you know, different things. We've talked about supply and demand and all that kind of stuff. You got to remember, we don't take a strategy of and by itself just because the 8 moving average has crossed the 34 here. That means I should get into the no. Remember, all trades are a story. There's a reason why it's doing what it's doing. We look at that in context of other things to say, well, what are the targets? Is there enough room for the trade and different things? We will look at some more stuff like this when we get to the live charts tonight. But again, remember that no strategy by itself is 100% foolproof. I have talked before about, like all the YouTube gurus. And I do not have a lot of love in my heart for a lot of these gurus because they come up with these flashy title names. I saw one today from a very, very popular trader. I'm not going to call his name, but he's a very popular supply and demand trader. And the title of his video was something to the effect of, I'm 100% successful. I said, what? No way. No way. So, okay, let me go see what his video's about. So I click on his video, and the first thing he says is, not all my trades succeed. But my mindset, if it falls within my trading plan, within my risk tolerance and everything, and I follow my plan, I consider that 100% success. And I was like, oh, for God, you really? Come on. But he had this title of, I never fail a trade. You got to be careful of these flashy little titles and all that kind of stuff because, they want you to click and watch their video, and they want you to give them a thumbs up and stuff. And so, like I said, I've said this many times before, but all strategies work sometimes. No strategy works all the time. You got to build a story here. You got to manage your risk and things like that. So with that being the case, let's come back here and let's continue talking about moving averages. Now, this is my opinion, but I believe that moving averages are best utilized, that they give you their strongest on the minute and the daily charts. Now, why do I say that? Moving averages originally came out on the daily charts. And then as we got more and more computing power, and people actually started trading on the 1-minute chart, especially our day traders, we find that moving averages are the most informative on the 1-minute chart. I can show you examples if you want, I suppose, of where you can see where a 5-minute chart and a moving average, the price went right to a moving average on the 5-minute or the 15. But in my opinion, moving averages give you the most information on the 1 and the daily. But again, my opinion. Let's take a look at this. First of all, this is an exponential moving average. Now remember, there's a simple moving average, which is just simply the average of the last 8 trades. This is an exponential moving average, which means they give more weight to the last 1 or 2 candles that compute this line. In other words, they may count the last 2 candles twice. So instead of averaging 8 candles, they actually will do candles, let's say 1, 2, 3, 4, 5, 6, 7, 7, 8, 8. And they give more weight to those latter candles there to show, and this makes the turn of it sharper, that it turns faster. Now, this is all a matter of personal preference. You got to figure out which one you like. And but the point I'm trying to get to about these moving averages, there's a strategy. We'll notice here that the stock has been staying above this average, and we would say it is riding above the 8, whereas over here we would say it is, below the 8. So here it is above the 8, but right here on this red candle here, it broke it. But then it went back up, and then it went back down, and then it finally decided, well, no, we're going down. So we start to see a pattern of these candles closing below the 8. Here, 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 here. Matter of fact, all of these candles closed below the 8. And so someone that may have taken a short here would say, as long as it closes below the 8, I stay in the trade. All right. Same thing over here. As long as it stays above the 8. You see, you got this pullback right here. Well, it still closed above the 8. And so you could say, well, as long as it stays in here, and the answer is, where do I get out? Right here. That's where it closed below the 8, and that's where you would get out. So if you got in somewhere around in here, you would get this move all the way up here, and you would lose a little bit of this here because right here is where it closed. And so, yeah, you would lose this top part, but you'd gain all of that right there. So that's a common strategy of, as long as it stays above the 8, the exponential moving 8, I stay in this trade long, or as long as it stays below, I stay short. Now, that's one trading strategy, but here's the moving average crossover. So red is the 8 moving average. Yellow is the 34. Now, by the way, if you were in last week's webinar, you might recognize the numbers 8 and 34. If you get it, type it into the chat. I'll give you guys a moment to see what's significant about the numbers 8 and 34. But at any rate, and then I'll come back and they are fibs. You are correct. Those are Fibonacci numbers. We talked about that last week. Very good. Now, traditionally, you'll see a lot of people also use the EMA 9. And there's a reason why some people prefer the 9 over the 8. This goes back to the old days that when people were on the New York Stock Exchange floor, when before they had all their computers and could trade at their desk and stuff, they had to be on the floor and holler out and stuff like that. And for a particular stock, they would have a sign, a board up there with the current price and the previous 9 trades for a total of 10. Well, you didn't count the current so much, so they would say it was the previous 9. And so a lot of people got used to saying that they always traded on the EMA 9. I like the 8. Is it going to be that big of a difference? Probably not. It's a matter of personal preference between the 8 and the 9. Yeah, so again, I like the 8 because I like Fibonacci's. But anyway, let's come back down here. So here we see that the moving average, the exponential moving average for the 8, crossed below the 34. And for a lot of people, this is a trading signal right here. They're saying now that this is clearly downward momentum, and we would look to be taking a short here because of this. Okay, well, all right. Now we're going to talk about why this is not such the greatest idea in a moment, but you said, well, where do I get in? If it crossed it down below, do I just automatically get in? Well, you could. The challenge that you have with this cross is, where does your stop go? Well, your stop would have to go either when you close above the 8 or at the top of this candle, which was the last candle before the cross. And you can see that's a pretty big candle, so you might have a pretty big stop there. You kind of have to decide what is right for you on that particular entry there, but here we're talking about this cross. Now, the other way to look to get into this trade short is what we'll call a retest right here. Let's take a look at what's going on. The price is coming down, 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 and then it exhausts. It gets tired. They won't go any lower. It comes back. We call this a pullback. And where does it stop? Right smack on the 8. Right smack on the 8, and then it closed south of that. So somewhere in here, or the break south of this candle, you could get into a short and ride this on down south. So as you can see, there's many, many different things. You can look at this. I mean, even Signet talked about that he studied moving average concepts for, I think he said, 6 months. Now, I'm sure it wasn't the only thing he studied, but he really did an in-depth study of moving averages. Now, where does this is, very clear, night and day, right here. You've got multiple things you can look at. You've got closes under the 8. You've got crossovers, different things like that. I want to draw your attention right here. You'll notice that the 8 and the 34 are just choppity, 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 chop. One right on top of the other. And there's no direction there. And 1 minute, this closed above it, then it closed below it, and we've got a lot of chop. And so one of the things that you'll need to learn is to watch out for chop and to mark that off on your charts. We will talk about that when we get to live trading tonight, or the live charts, if we have time to do that. If I forget, remind me about to talk about chop, how to look for that, how to mark it off, and how to say no trading in chop. Okay? Because a lot of times if we go back in time, we can actually see that there'll be some earlier area that will tell us, that will predict this chop. But at any rate, so here, again, just a very quick recap. Riding above the 8, riding below the 8, that's a strategy there. Here's a crossover strategy. Here's an entry into the 8. Let's say that you missed this. You were going to go below the 8, and you come in here, and you don't care about the crossover. You just say, oh man, it's below the 8. Where can I get in? Where can I get in? Right here on the retest. Right, so that it comes back up. It hits the 8. Notice also the 8 can act as a support resistance. Our very first night we talked about support and resistance. So can the 34. So can the 89. All these are Fibonacci's. You'll see this is very common, that a lot of times a moving average on the 1 or the daily. Yeah, okay, you can also see them on the 5, the 15 minutes, and so on, but you'll see them more frequently on the 1 minute and the dailies. Excuse me. So, but the point being is that if you walked in here and it's right here, should you get into this trade right here? And the answer is no. Why not? You're chasing. This move started up here. You don't get into this trade down here. Why? It's too late. It's too late. Matter of fact, if you got into this trade right here or here, you would be nervous when this happened. Because if you got into this trade right about here, let me try and put a line on that. Let's say that you got into this trade right here. Well, that's a fat line. Golly, maybe I have to try and, can I make that line skinnier? I don't know. Anyway, whatever. But if you got into this trade right here, and then it goes down, you're like, oh, yeah, it's working, and then you see this happen, what's the first thing? You may actually get stopped out. You start to panic. You got in at the wrong time. So, because we would call this chasing. It's already started happening. You need to stay out of the way of that and wait for an entry point, and that entry point would be right in this, right around here. Actually, it'd be, for me, it would be the break of this red candle. When I see this candle's low right here get broken, then I would be in that trade short, and I'm writing the 8 down. All right, so there's a fair amount about moving averages. There's all kinds of stuff that you can really learn from moving averages. We'll look at some of this in the live charts tonight. Any questions about the stuff that I've talked about here? I'm looking at the YouTube chats. I'm also looking at main chat over in our Discord group for those of you that are over there. If you have something, feel free to type something in, and I'll give that just a second. But while I'm waiting for any questions on that, moving averages are really cool. They also help confirm the trend if you're looking for something else. I mean, if you're trading a different strategy, you can use a lot of times the moving averages as a confirmation. So let's see. I am seeing a very, very long delay on my side. Oh my gosh. Wow. It's like 15 seconds. Okay, it was 4 seconds to start with. I got to get in and figure out what's going on with that. Anyway, all right, well, I'm not seeing any questions come up. If you do have some questions, type them in, and I will go back, because this delay is really turning out to be a problem, apparently. Moving on. Here we talked about support or resistance. So here we see on the 1 minute, let me bring my little cutesy highlighter thingy up. Here we see we're on the 1 minute right here. And right here we see we came up to the 89. For me, that's green. The 89 EMA, bam, stopped right smack on it. Rejected off of it, came down here. Now it did cross the 34 but with a wick, but it did stay above it as far as the close. Went back up, bam, hits the 89 again. Here we see what's going on with this 8. This is where I was talking about this choppity chop. Here we go. The 8 crosses the 34, it goes up, and then it crosses back down, and it tries to go back up. We want to watch out for these chop areas. Kind of thing, because we don't want to get caught in that chop, because you can see if you were going to take the break of this candle south, you'd have turned around and gotten stopped out up this way and so forth. We want to make sure that we avoid these little chop areas, and so we kind of look for that, and then we'll come back. Like I said, we'll learn about chop, and we'll try to stay out of that. And now we can kind of see that here we've got a good trade going down here. Now it doesn't last very long. Obviously, as you can see, we've got this so here we closed below it. We take the break of this green candle. Now, where would you get stopped out on right here? And the answer is it did not close. Now it did push back against it. My stop would probably be the high of this red candle, and we did come up to it, but we didn't break it. So yeah, you'd take a little heat here. You'd be sweating a little bit. One more tick, I'm going out. Oh my gosh, but it works out. Boom, boom. And then it comes down here, and when you see these dramatic moves like this here, is when you would start moving your stop. I'd probably put my stop here. Then this candle closes down here. We get this inside candle right here, which tells me that, what does the inside mean? Inside candle means indecision. Nobody could figure out which way to go on that candle. There wasn't enough buyers or sellers to push it really strongly one way or the other. So it stayed inside. Versus this blue candle here, the bears slammed this candle right here. Now it did actually go backwards. The bulls tried to push it up, and then the bears said no, and they slam it down hard. And it's an outside candle, though, because it tells us that they really, both sides really threw a lot of money at moving the stock around, but ultimately the bears won. So here they couldn't figure, there was no clear direction. Here there's a lot of money being thrown around to move this stock, but ultimately the bears won out. We see that obviously in the next candle, We've got some indecision here. This broke hard down here. And when you see these big breaks like that, you want to just keep moving your stop down. Your stop probably, therefore, should be right here on this red candle. And you would have gotten nice run right there. Riding down the 8, riding the 8 down. But again, let's take a look at some of the other things that happened again with this here. Here we are more or less kind of riding the 8 up a little bit. Here we're kind of chopping around the 34. We're going back into chop. See, the 34 and the 8 are coming together, and it's not a very clear cross right here. So, that's kind of, we're going back into chop. So, again, you can use these moving averages. You can build a trading strategy around it. You can also use them for targets. There's just a lot to learn when you study moving averages. I keep them up on my charts just because I want to see them. That if, let's say, if I was going to target this happens to be the pivot point up here, and if I was going long right here for whatever reason, and I say, well, I need a target. Well, I say, well, there's a pivot point. Well, there's a moving average in the way, and I would set my first take profit on that moving average. My second take profit would be the pivot. Because as we see right here, I would have taken my profit out here and then stopped out break even on my runner. All right. Any questions about that? Oh my gosh, this delay is awful. So, okay. That's what I get for going to YouTube and finding some dude who's like, these are the best settings for OBS when you're streaming on YouTube. These are like the king. This is the granddaddy. Yeah, right. Anyway, okay. Don't take trading advice from YouTube gurus. I shouldn't have taken OBS setting advice from them either. Okay. I'll do better next time. Let's move along. Now, patterns. Wow. You first can look at this and you can be really, really intimidated. And you don't have to be. You really do not have to be intimidated by this. There are, you'll learn them. You'll get it. You'll notice that there's a lot of commonality in these patterns. The first thing let's take a look at is that there are reversals. On the left here it says reversals, and there are continuations. So the top half are reversals, the bottom half are continuation patterns. Let's take a look through some of these really quick. And the first thing we see here is a bearish double top. Now what are we talking about here? We see, notice it's a reversal because, let me get my little pen here, and let's go, we're moving this way. We are bullish. And then we come up here and we get, that's as high as we're going to go. Pulls back. They try a second time. Now what's important to notice here is that these 2 points, those 2 highs right there, are basically the same. They don't have to be exactly the same, but they're basically the same. This line here is called the neckline. And it's because that's where this point right here ended up. Right? That's where this pullback went. We call that. So that makes this the neckline. And what we're looking for is when the price breaks that neckline and starts heading south. So that's called a bearish double top. Here we have a bearish head and shoulders. Again, bullish coming into it. We have a high, a pullback, a higher high, a pullback in the same area, which now gives us the neckline. The third time it was just worse than the second time. And then when we break the neckline south, now we're going down. Okay? Now, these are very common pattern. Again, if it helps, make yourself a set of flashcards within, what do you call those? Paper stock cards. Anyway, you make yourself some flashcards or something like that and kind of study some of this kind of stuff. Let's take a look here at, this is called a bearish rising wedge. Now, I'm not going to go through all of these necessarily, but what I want to point out to you is this. Notice the compression. It starts wider here, and then it gets more narrow, more narrow, more narrow. Also notice, now again, we're bullish coming in. We start to compress as we come through. Notice the slope of these two lines here. Both of these slopes are upward slopes. So I want you to think of it like a beak of a bird, and the bird's looking up. So the bird's beak is is upward trending. We were bullish coming into it, so we break coming down. This is an expanding triangle. Again, we're looking up. Notice the beak, although this is the kind of the opposite, where instead of compressing, we are expanding, we still are looking up. If this is a bird's beak, he's got his mouth open, he's looking up, okay? A bearish triple top, exact same concept here that happens here, but notice the thing is that we did not break the neckline on that second run. We went back for a third run. So really this, and this, they're all really the same thing. None of them broke the necklines. Now, let's just take this entire top row and flip it upside down. Instead of a bearish double top, we have a bullish double bottom. One is just a mirror of the other one. All right? So, we have that. Bird's beaks looking down, looking down. Notice here also. So what was happening when the bird's beak was looking down up here? We went bullish. We came out of it bullish. Well, here we are, bird's beak looking down. Bird's beak looking down. We broke out to the north. Again, same thing. Now, this is an interesting one right here. Symmetrical triangle. The bird's looking perfectly on the plane, flat on the plane, in which case you're not 100% sure which way it's going to go as far as anticipating, but all right. Now this one here, you say, well, this is bird beak looking up, but which way were we coming into it? We were bearish coming into it. We were bullish going into this one here. Again, this top pattern here is just simply flipped down here. This fourth row is simply a mirror flip. After you do this for a while, you'll kind of start to recognize the ones that you really, really will pay attention to. You'll start to spot these pretty quick. You'll start to spot these very quickly. When it comes to these wedges, there's other ones called flags, where the stock just simply, well, that's not right. Anyway, it comes up and it just simply kind of goes completely like this for a while, and these two lines are parallel. And which I guess is this. I guess is that, yeah. And some people call that a flag because it looks like this. Kind of a P or whatever. It looks like a flag on a pole kind of thing. Anyway, now, how successful are these kind of patterns? Are they really that successful? Here's the thing to understand about patterns. Patterns are psychological. Patterns, because we see things like looking into the clouds. We look into the clouds and two people look into the clouds and one person says, oh, I see, a dog's face, and somebody else looks up there and sees, I don't know, my alarm clock or something stupid. You know what I'm saying? People see different things, but these pattern ideas turned out to be very psychological because they're old. This is pre-computer kind of stuff as far as people would look at these charts and they would see these patterns. And so again, like I talked about last week, a lot of things are tradition. This also is tradition. Now, how probabilistic are they? They can be fairly probabilistic, whatever. The head and shoulders. Now, here's the problem with the head and shoulders. Is it always perfectly textbook? Well, no. Sometimes it looks like this. And you may say, well, that's not even. It's kind of lopsided, wonky, as we, or janky, different terms that people use. And, you say, well, is that really a head and shoulders or not? Because it's really not. I don't know. Again, they're not going to 100% be perfectly always perfect. And especially like these wedges here, you might actually see a candle wicks out, but it closes inside the wedge. And generally, we're looking for the close. We're really looking for the close, not necessarily the wicks on this kind of stuff. But as you look at these kind of patterns, you will see that they're fairly common. You'll see them all the time. And the point being is that because you see them, other people see them as well. The algos know what they are. They see them. And so there's no particular rationale for a lot of these patterns. But because they've been around for so long, day traders, algos, and stuff like that are aware of them and will trade them accordingly. So, but again, taken in context of the story of what else is going on with the what's going on. So we got a question up here. It says, how do I tell the difference between the ascending triangle ascending triangle here and the bearish rising wedge, which is okay. It is on the ascending triangle, this is flat. And this has a slope to it. That's basically it. Let's be honest. Really what you're looking for, and this is a really good question. These two patterns almost look identical, and this is never going to be perfectly flat. But you generally are looking at the break. You generally, can this go zoop, 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 zoop? Sure it can. And you can trade the break, even though we think it's going to go this way, but no, instead it actually went this way. And you can say, well, I'm trading the break, because then you would call that a failed ascending triangle. And so, yeah, you could take that trade on that. What you're looking for, especially in these kind of getting narrow, is this concept of compression. And this, much like we talked about the box last week, when we said you have a wait, let me do this. I'm going to turn the time off, timeout. When we talked about that box last week, and we said, well, here, blah, 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 and I got a high, blah, 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 and I got a low, and then I got a retrace. And so we said, well, I didn't draw that very well at all, but let's see, I can go back, can't I? Yeah, let's try that again. And so we drew us a box here, and we said when that thing breaks, it's going to run. Well, what does this have in common with this? Well, they're both consolidation. They're both consolidation. And what happens in consolidation? Well, everybody's working out the next move. And so oftentimes, the next move is explosive. Now, it doesn't have to be totally, but a lot of times when you see this kind of compression going on here, getting tighter, that is planning an explosive move. And so, are you going to see necessarily an explosive move here? This is like a box. This is kind of like this idea here, a high, a low kind of thing, and then a 50% retrace back inside the box. But the point being is that what you're looking at is that it's not, the price is not, it's a pattern that we can see. We see these compression patterns right here. We see it here, 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 here. You know, here, here, and so on. You notice the majority of these patterns on the board, on the screen, are compression. And so when we see that kind of compression, it's like winding up that spring, getting it tighter and tighter and tighter, and when it pops, bang, off it goes. All right? So that's the main idea. Does it have to break according to the pattern? Not really. It can go the other way, and it's still a potentially valid trade. Just be ready for it. Okay? All right. And if you got any more questions about it, type them in. I can always come back to this slide here. Ooh, let's get this off the screen. How do I clear the whole screen? There's probably a way to clear the entire screen, but here's an example of a head and shoulders. And I'm going to turn my delay thingy back on here, and we'll get it. Here we are. Notice, first of all, bearish. Here is the left shoulder. It pulls back. Here's the head. Here's the right shoulder. What do we set as the neckline? Well, we set the neckline, the line that's furthest away, because you could say, well, is that a neckline right there? Well, the one that's furthest away is this one. So we'll go with this one. And we see that price did close outside of it. It did actually pull back in, which doesn't always happen. Usually it actually breaks and goes, but away it goes. And so there we have a bearish reversal in a head and shoulders. Now, the one thing to remember is, with this kind of stuff, it's always fractal. What do you mean fractal? Meaning that you might see this on a daily. You might see it on an hourly. You know, you might see these patterns on the hourly. You'll see these patterns on all different time frames. There's no pattern that you only see on the daily. No, you'll see head and shoulders. You'll see rising wedges. You'll see all kinds of stuff on all time frames. And the reason I say that is when you're looking at making a trade and stuff like that, you oftentimes want to go look at those higher time frames. We're going to talk more about that next week to look for these kind of patterns. But anyway, that's our example there. All right. And I have to go back to my arrow in order to advance the slide. Oh my gosh, are there books and books and books and books and books about candlestick patterns? I'm not joking when I say that there are books that are hundreds of pages about candlestick patterns. And oh my gosh, you can really, really honestly just really get your head wrapped up in this kind of stuff. And what I want to point out, though, actually, let's just go over to my marker here. All I am mostly interested in, me personally, is going to be this right here. That right there. Dojis and spinning tops. Now, you can learn all the others, and that's fine. You can absolutely learn every one of these here. Here's 3 white soldiers. Here's 3 black crows. But I want you to look for dojis. Now, what is a doji? A doji you see here is where the price, the candle opened. It got pushed one way. So it opened here. It went down. It went back. And then it came right back to the open. And you can see it in that tiny little line right there. It came right back to the open. Now, a doji and a spinning top look about the same thing, aren't they? They are essentially the same thing, except for a doji is where it literally practically came back to the same point. It closed on the same spot as it opened. A spinning top just means there was a little bit of wiggle room in there, but I want you to notice that the spinning top is in the middle of the candle, not This is not a spinning top. Let me turn that delay off a little bit there, or back it off again. Let's do that again. This, okay, that's a spinning top, a doji. This is not a spinning top or a doji. It's got to be in the middle. That represents indecision. Now, there are candles. I'm looking for gravestone doji and hammers and stuff like that. But anyway, forget. Now, moving on. Now, let's put some of these dojis and spinning tops into patterns. Here is an evening star. This is a very common pattern. And what will happen is we're going north. We stall with a doji or spinning top, which means that we just didn't have the momentum to keep going. We reached indecision, and if it breaks the bottom of that doji, we're going south. Right? Same thing here is called a morning star. Same idea. We were bearish. We put in the spinning top or the doji, and when it breaks, if it breaks, it will go the other way. So the main ones that I would want you to focus on, like I say, is this whole thing right here about dojis and spinning tops. And there you can see there's all kinds of patterns on them. Now there are, here's one called a gravestone doji. It's just that one right there in the middle. You can kind of see that that's not a spinning top or anything like that. Hurry up and time out. Stupid thing. Let me get that off the screen. You can see, though, that it right here, it's at the very, very, very bottom. And just like there's a spinning top, there's a dragonfly doji. If we have this, we have a hammer. And and this is called a hanging man or a shooting star. Or excuse me, that's not what I wanted to say. Actually, I wanted to talk about this one here, shooting star. Forget that one, because that looks just like a hammer. But we'll call it typically we'll refer to this as a hammer. We'll refer to this as a shooting star, and so on. Okay. Any questions about this? I know we're running a little bit. I seem to be stuck in this rut of running behind on all these because I love to talk about some of this kind of stuff here, but I do want to make sure we have some time to get over and look at some charts. Anyway, I am, like I say, for some reason I've got a huge delay from where I'm talking and where you guys are seeing it. So, but if you do have a question, type it in. I can always come back to it. All right. Would I spend the time to learn bearish kickers and all this and abandoned babies and all that kind of stuff? No, I don't. You can if you want to. If you're good at this kind of stuff, there's nothing wrong with it. Nothing at all. But I would not sit. I mean, my goodness, piercing lines. Now, you may hear people talk about this tweezer bottom, and that tweezer bottom is two adjacent candles where it literally is the bottom of these two candles is identical. They're adjacent, and thus the low of these two candles is identical. Tweezer top, two adjacent candles, and the tops of them are identical. You'll hear people talk about tweezers and things like that. So, just kind of be a little bit familiar with it, but your focus should be on dojis and spinning tops. Okay. And I got to go back. I'm trying to get used to using this epic pen thingy. Click. Now move it. Here's a doji. It's not perfectly doji, but a doji represents indecision. So what happens? How do you trade this doji idea? The way we're going to trade this doji idea, and in fact, you've got a spinning top right here. Generally, now this is actually a very mixed slide right here. I'm going to focus on this one because the smaller this area is, the body of the candle, the stronger this is going to be. We see here that it broke the bottom of that and took off. Well, now you can look at this and you can clearly see that we've got this spinning top right here, and this candle did break it and go high. Yes, it did. Yes, it absolutely did. Now, here's where I want to talk about one thing. Again, we've talked about this, well, a little bit in the past. We're going to spend a lot more time on it next week, and that is the trend. And what is the trend here? Well, the trend here is bearish. So if I were going to take this candle here, I would only take this candle if it was bearish, unless I had some compelling reason to go north. Same thing. I would only take this candle here if it was bearish. Why? Because the trend is bearish, and that means the move is stronger in your favor, more predictable, that it will run stronger in your favor if you trade. So yes, there is a doji. This is a spinning top. Would I take this trade north? No. Would I take this trade north? No, because it's against the trend. You know, unless I had some other information up here that told me, you know, that there was part of the story. Remember, all these things should be part of a story, not the total story. Part of a story. So here I've got a doji, I've got a trend. I'm going to put these two together and say I'm going to take it when it breaks bearish. It does finally break bearish right here, and you get this run here. All right. And I've got some slides also that I'm going to show you in a minute. Actually, I'm going to go ahead and let me pull that up. Right there. Here. Again, here's trade of 8. What do we see? We see that, get my little eraser, my marker thing. What's the trend? This is a live chart. This is from today on the Russell, on the RTY, Russell 2000. Here we got a doji. We even got an inside candle sitting beside it. And boom, it's triggered. It's triggered. I'm going long. No. Why would I not take it? Against the trend. Trend's bearish. On the other hand, you say, but the trend is bearish, and we took this one here. Well, you say, well, why would I take this one long when I wouldn't take this one long? And here, I would, you could say, well, I'm going to take this long right here, or I'll take it short right here. Fair enough. But why would I, could I see this candle right here and say, well, I should take it? Well, where would I actually enter? I could take this, but not. This is going against the trade. I wouldn't take this break. I would take this break. In other words, I got a doji, or a spinning top. The candle starts to move, but it could just stay back here and then go south on me. I want some confirmation. Where's my confirmation? If it takes this candle out, this red candle. Now I'm saying, okay, this is a trend reversal, very possibly, and so I would get in here and take that. Because this candle's going against the trend as far as breaking it there, so I want a double confirmation. Here's one confirmation, it broke that. Here's the second confirmation, it broke that. And so now I'm more confident about getting into the trade. Again, none of this ever says that it has to do anything permanent. It may not, but, we don't know. We just have to look and see. Let's pop back over to our slideshow. All right. Now, we're coming to the end here. We're going to talk about volume. Volume is by far one of the most underrated things when it comes to trading. Absolutely underrated. People just really don't pay a lot of attention to volume. And I guarantee you, volume is very important. Volume tells you where they are willing to spend their money. Remember, us retail traders, we do not move the market. Well, maybe, okay, at certain times of the day when the institutional traders are not doing a lot, we may nudge it here, we may nudge it there. The moves in a ticker, whether it's a stock, whether it's a futures, whatever, it comes from institutional people, traders, unless you're trading penny stocks or something that's got an average daily volume of less than, 5,000, 10,000, and there are tickers like that. But we're not going to waste our time with that usually. That's horrible. Don't do that. We want to look at tickers that have volume. So what is this? Now, this is a study called Bulls versus Bears on Trade-O-Vate. If you're looking at a normal volume on your thing there, this would just simply be a red candle. This would be a green candle because it's more green. It's more than 50% green, so this would be green, this would be red, and so on. On this study here, they actually break it up and show you the ratio, but my point being is, it's not so much the color. It is the magnitude of it, the size of it. Look at this candle compared to all the candles before it, until we were over here. And my point being is that this candle, it tells us that they were throwing money trying to move it down. Does it always work? No. This is mostly people trying to sell it. And if we go up, it actually lines up with this candle right here. And, oh, well, yeah, actually you can. It's off the screen there, but you can see it's this red candle. They just slammed it down. Why is that important? Why is that important? But it tells us that the institutions are throwing some weight around now. And if they're throwing the weight against them, you're not going to make any money trading against them hardly. Don't try. Go with them. Now, you got to find your entry points and stuff. But we're saying, what we're saying here is that the institutions are spending the money. A lot of money. Matter of fact, I don't know what the scale is here. I chopped it off here. But it looks like it was maybe around 3,000 shares when I took this chart, is how many shares were thrown to, or 3,000 trades, 3,000 trades happened in this 5-minute gap here to slam this thing down. This really tells us where the institutions are spending their money. And so when you see that, you need to pay attention to that, because that tells you where the institutions want this market to go. They want it to go down. There's another thing I want you to see here also, though. Notice how this starts to go back up. All right, you see that right there? It came down hard and now it's starting to go back up. There's a reason for it. This is a fair value gap right here. If you were in one of the earlier ones, you'd recognize this fair value gap. So it came into the gap and it rolled over. But notice the volume is actually going down. We call this a weak move, W-E-A-K, as in not so strong. A weak move because there's less volume going into trying to move this up, which tells me that when I see this diverge, it's not really not divergence, but it's weak here, so I see that the stock's going up, but the volume is not supporting it to continue, tells me it's not going to last. It's going to continue back in favor of this candle right here, that volume candle, and sure enough, down it goes. So when we look at that, let's go back over here to this chart. Let me add, oh, I'm going to turn the pen off. Let's add Bulls and Bears is just my preferred one. And let's take a look. Again, this is the Russell 2000 from this morning. Look at it. Right there it is. What did they want to do? This candle happened right here. They wanted to push it down. Let's widen this out a little bit so you can really see it. And let me get my pen out here. They wanted this stock to go down. So they threw a lot of money to make this candle go down. And they threw a lot of money at this candle to make it go down. Now, this also happened right here at the 9:30, 9:45 hour. That is an exception because if you know the Eastern time, that's market open. So we know here that the markets really, that's when the bulk of the money comes in, is at that 9:30, 9:45 time, except for right here at CPI. Here was CPI this morning. That's an exception. But what are we seeing here is they wanted it to go down. And so they took it down as much as they can. Now we're into normal volume. We have now gotten out of that first opening order time. So there's a gotcha. 9:30 Eastern time, market open, whatever time that is for you, 6:30 if you're West Coast. You kind of have to ignore what's going on here. That's when the institutions are placing all their big orders. And then now, though, we're going to start looking at about 9:45. And what do I see at 9:45? I see big green candles of volume, and they wanted it to go up. Well, what happened? So I'm trying to visually line this up. We got this nice move up. So here we are, we're outside of the morning opening, and these three candles right here, which would be normal trades, now that we're out, wait a minute, what about this big red candle here? Was it bigger than the candle before it? No. So it's a pullback. It's just a pullback. As a matter of fact, let's take a look at that pullback. What do you see right here? You see we're coming down, but what do you see going on here? There's not a lot of volume in that move. They're not spending the money to push this down. So what do we call that? A weak. Remember, W-E-A-K, as in not strong, a weak move. And so what happened? After they did their weak move, here comes the push it back up. So looking at, you can trade just on price action and volume alone. Absolutely. You can trade just on price action and volume alone. But the volume will give you a clue as to what is going on. Now, volume does dwindle as we go throughout the day overall. As you can kind of see, if we look at from the 9:30 open, it does dwindle overall. I'm on a 5-minute chart. It just kind of does because the bulk of the trading is done in the mornings. But there still is trading going on in the afternoons until we get to the power hour, 3 p.m. to 4 p.m., when the last of the day trades are done. And so we see, obviously, we've got a huge candle here. But to be honest, though, did it really do that much? No. Even though they sold the fool out of it. And this is what's called a market on close order, MOC. That's the reason this candle is so big. Again, so let's kind of ignore that very last 5-minute candle. So we can see here that the volume over the day does drop. So when you're looking at volume, you have to look at it within the time period. You can't compare the 2 p.m. to the 10 a.m. volume because, well, 2 p.m. is just generally going to be shorter, smaller. So you just kind of have to look around it to see what's going on. All right. Volume is very, very, very important. So, anyway, questions on that? I know we're starting to run over time here. And so I do want to kind of tie some of this other stuff in with charts and maybe take about 5 minutes, 10 minutes and look at some charts about the stuff we talked about. Let's put some moving averages on this thing. That's not what I want. I want EMA's volume and the squeeze. Now I'm just going to get this off the screen for the moment. I'm not interested in that. Here are our exponential moving averages. Let me point out here what they are. We have, as a matter of fact, now this is from, I want to point out, Today is the 12th. I want to point out this is from today. And let's go to the 1 minute. And let's see if I can get us over to the morning trading session here. And let's take a look at this. All right. We had CPI came out this morning, and as you can see, it went crazy, crazy, crazy. Now, if you're trading futures, of course, you can get in on this action if you want to. I generally prefer, I might take a few little trades in pre-market here, but I generally prefer to wait till after market is open. So here we are. Market is open, and I told you, ignore the first 10 minutes. So let's just kind of ignore the volume on the first 10 minutes. So let's just kind of take a look at what's going on here. So what do we see? 941. We've got 940, 941. We've got two very good, strong upward candles. We do have some pullback, but was the volume very strong in those pullbacks? No, this is a weak move. So eventually it turned back around and went where these bigger candles were wanting it to go, up. So there it goes. It goes up here. Let's take a look at these moving averages now. Here is the cross of the moving average. Here is closing above the 8. Now, how can I look at this? First of all, let's start with this green candle right here. What have we got here? We've got a doji. Ooh. We've got an inside candle. We've got a break to the north, this candle right here, which actually is kind of doji-ish. It's not exactly, it's not dead center, but it's still kind of doji-ish. And it took out this inside candle, and it took out this doji. And so maybe we did enter long here. Where does my stop go? Let me get my little halo thingy. My stop is whatever, if I'm trading off this doji right here, then my stop is the bottom of that doji. So we went long here. So there's a strategy. We went long on the doji, possibly, or the close of the next, or you say, well, you're going against the trend, so you shouldn't maybe take that. So let's say, okay, well, if I'm going to go, I could use these candles here to tell me that they really want the markets to go long. That could be part of my story. I could say, you say, well, Marziti, you said earlier you wouldn't take a change in trend until you had a confirming candle. Okay, then I would get in here. The minute this candle breaks this candle's high, I could be in that trade right there. And we can rate, so that was the Russell's price of 2081. That was approximately the Russell's price. And so I could ride the 8. And then, whoa, I saw a doji right there. I saw a doji. I also saw the 34. Look what happened when it got close to that 34, the yellow line. It stalled. Resistance. The 34 acted as resistance, so I might have me a take profit right there. By the way, there also happens to be here, you'll see this white line right here. If you've been in the earlier videos, that's also a pivot point. Do you think there's some strength in a pivot point and an EMA at the same time? Yes, there absolutely is. Notice it stalled the whole thing. What did it do? Well, it came back and it tried to reverse. But it stayed above the 8. Okay, it marched on. Look at right here. It stalled on the 89 a little bit. This purple line here is interesting. This purple line is another type of moving average called VWAP, volume weighted average price. This is done by the ticker. This is not something you choose. VWAP is the same on all time frames. All time frames. It's in the same place. It's in the exact same place on all time frames because it is basically a mathematical computation of how many shares were traded at a certain price. And that's going to be the same on all time frames. So, if I change the time frame and I go to the 5-minute candle, well, my averages are all totally different. Let's get over here. You can see here my averages are all totally different. In fact, here on this one, if you barely notice VWAP, my purple line is below the 34. But no matter what time frame you're on, VWAP is always in the exact same spot relative to the candles. But my EMAs moved. Let's go back to that 1 minute and look again. Again, notice the 34 is above, the yellow line's above purple. Here, let me blow that up so y'all can see that. But now let's go back to the 1 minute candle. And now I got to find my thing again. Where is it? There it is. And here, it's below it. So, if you're actually looking for a dead, absolute, never moves moving average, that would be VWAP. Notice that we resisted on VWAP. Notice that VWAP and this pivot point, so there's a coincidence, there's two things that coincide. Two things right there. There's a pivot point, this white line, and VWAP, and look what the ticker did when it got to it. Bam! That stopped it dead in its tracks. It rolled back over, broke through the 89, broke through the 8, broke through the 34, choppity, choppity, chop. Down it comes. I'm going to talk about chop. I said I was going to do that. No, would you call that a doji or a spinning top? No. The spinning top is more skinny in the middle, like this. That's a spinning top. That's a spinning top. That is just, you could say, well, it's got a wick on both ends. All right. We're splitting hairs, Mary. We're getting really whatever about it. But at any rate, all right. You could if you really wanted to, but nonetheless, the trend was down. We'd have to wait for the break. It would not be this candle here. It would have been more this. Oh, look in there. Right there. See where that candle stopped? Can you see that wick? Right there on my green line, which is my 89 EMA. Interesting. And so on. So go back and just study some of these charts. Now, I want to take this last minute here. I'm over time. I want to take this last second. And if you guys got any last minute questions, because I'm going to wind this down right now, about CHOP. And what is CHOP and where is it? CHOP is a consolidation area. And I'm going to draw one right here. Right here. See all this consolidation right in here? Now, let's see what happens with CHOP. Went into the CHOP, came out of the CHOP. Went into the CHOP and chopped around. Went up just about choppity chop. Look at this whole area right in here. Just choppy, choppy, choppy. Went into the CHOP and came out of the CHOP. We're headed down, boys. We're headed down. Hit the chop zone. What do we do? Chopped. What do we do? Do you see that? You want to look for these kind of area. Oh, do you see it? Do you see it? Right there. It's that the right shoulder is not very strong, not very pronounced. This left shoulder is very pronounced. This right shoulder, it does go up higher, because here we do have a couple of these. I got used to using this pen thing. These two right here do take out these candles here, so it is sort of kind of a right shoulder. And look here, here's a neckline right here. And what did we do when we broke the neckline? So here's a here it is. We are bullish. Left shoulder, right shoulder, a very weak right shoulder, or left shoulder, head, right shoulder. It's weak, but it's there. Neckline. Down we go. There it is, right there in front. I didn't see that beforehand. You just got to train yourself to see these kind of things. You know, you just look at charts and you look at charts and you look at charts for them over and over until you see them. So again, what are other choppity chop areas? Here is a choppity chop area right here. Reversals. And right there. See it? I marked it over here. It was a reversal. I get over here. Choppity, 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 chop. What do we not do in chop? We do not take any trades. Never start a trade inside the chop unless you've got an amazingly good reason for it. Never, ever, 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 ever. Now, you can have a target inside the chop, but you never start a trade in the chop. Why? You get stopped out all over the place. Because as you see, what happened here? This was on the 5 minute, so I can let me get that off the screen. No, I don't want to get that off. What did it do? It went down, it went up, it went down, it went up, it went down, and it went up. How are you going to trade that? You see? So we do not start a trade in these chop zones unless you have a really, really good reason. But they can be targets. So, folks, I am overdue on time here, so I need to wind this down. I really hope we got something out of this tonight. And next week is, not next week, Thursday's session number 4, is going to be a lot of looking at charts, wrapping up, talking about setups and things like that. It's not going to be so much introducing new patterns or anything like that, but it's going to be sort of the putting it all together and things like that. So I hope you've gotten something out of tonight's video. And of course, if you've got, for those of you that are our Bullish Bears members, you're more than welcome. I'll be watching the main chat tonight, and I'm happy to take questions there or whatever else kind of things. So, run my mouth long enough, and I hope you guys have gotten something out of it. We will see you next Thursday, and y'all have a really good evening. This is Marziti signing off.